morning, everyone. Welcome to Phillip Securities Research Weekly Market Outlook. I'm Waywen. I'll take you through the market outlook for this week, followed by Richard, who will take you through our featured company for this week, which is Garmin. Alright, last week we saw equity indices in the US and even closer to home in Singapore and even Japan hitting all-time highs for the US and 5-year highs for the Nikkei as well as STI. To give our clients a sense of perspective, we actually share with everyone two charts on this slide. The first chart here shows that equity premium has actually essentially reached a historic high. What this means is that there is value in the markets, right? And this equity premium is actually essentially elevated across all horizons from 1 month to 5 years. All right. The key risk event for this week will actually be Bernanke's testimonial before Congress, where he will testify before Congress on 22nd May, and we will get greater clarity on the pace of the large-scale asset purchases as to when the Fed intends to scale back on these large-scale asset purchases, and that will be the key risk event for this week. For the US, it has reached fresh highs again for the S&P 500, but we think that the 1650 level could be retested again, right? Nikkei is at a 5.5-year high. As we have mentioned previously, the Japanese economy is in an upturn, right? Indeed, we saw private consumption gaining ground in first quarter due to the wealth effect as people reap gains from the stock markets, and even Japanese investors themselves are rotating from the bond markets into the equity markets, right? And also in Japan, we saw core machinery orders gaining higher, and that means that businesses are actually investing ahead. Alright, so in Japan, that's for Japan, and HSCI, we think that it could retest the 11,000 level and possibly the 50-day moving average support level. HSI, our bullish case for HSI remains intact as long as the HSI remains above the 22,500 level. We think that it's on track to challenge the 23,500 level. STI remains the same. We think that the STI is likely to challenge the 3,485 level as long as it remains above key support at 3,320. For the Thai index, it's essentially consolidating, right? Key support is pegged at the 1,600 level. For the Jakarta Composite Index, Friday it moved up higher, but we like to caution our readers on one thing about Indonesia. So essentially last week, Bank Indonesia in its monthly monetary policy meeting, it actually stood pat. But we like to caution that should there be a scale back in fuel subsidies in the months ahead, right, which is increasingly likely due to the fiscal strain that it poses to the economy, that would essentially warrant a rate hike, which could be a negative for Indonesia equities. KLCI, which we are market rate, what we are seeing right now is that the relief rally from 2 weeks ago, post-GE, post-13 general elections, is essentially fading. And until we get greater clarity on the policy front, particularly on the ETP, Economic Transformation Program, we remain hesitant to upgrade Malaysia to an overweight. With that, I'll pass on to Richard for this week's featured company, Garmin.
Hello, good morning, clients. Welcome to our weekly market call. Okay, I'm Richard. Today I'm going to share with you our featured company, Garmin. Okay, here is a snapshot of the trading stats of the company. For the past 1 year, you can see a chart and the 52 weeks trading range. Currently, on Friday close is at $36.88, the lower end of the 1 year trading range, and it gives you something close to 5% gross dividend yield, and it is a 7 over billion market cap listed in the US. Okay, Garmin is actually a vertically integrated company that designs and markets GPS technologies under its own brand name. For those of us who drives, we will associate this company largely with the portable navigation device. And over the years, this device has been in a secular decline, and it is perceived by the company, by the market to be in the sunset industry due to the increasing smartphone adoption. In a sense, the perception is correct because the revenue from these operating segments has declined from 2009 to 2012. It declined from about 2 billion to about 1.5 billion. On the other hand, this segment actually still generates a very healthy pre-tax profit and on a very respectable operating margins of 15%. And at the same time, Garmin is also growing its other segments, namely the outdoor and fitness. Also some heavily R&D on its aviation and marine. And these other segments is picking up all the slacks in terms of operating income from the declining trend in terms of contribution from the auto and mobile segments. As of 2012, the automobile operating income contribution has withered down from 59% in 2009 to 37%, while the other segments have, which is now contributing 43% of the total revenue, but has make up of 63%, almost 2/3 of our operating income. Okay, as this table here, we can see that the growth in the other segments has continued to offset the declines in the automobile segments, and also maintaining a very decent operating margins blended across the different segments of about 20%. And also because of low capex requirements, the free cash flow has been consistently higher than the net income over the past 4 years. As such, you can see Garmin has been increasing their dividends per share payout from 75 cents to $1.80 from 2009 to 12. Okay, now let's bring you through the first segment in automobile. Here are some of the familiar devices in this segment: the portable navigation device and factory installed in-car navigation systems. They have been winning awards for these installed systems in cars for the models like Chrysler, Suzuki, and also recently they signed up partnership with Mercedes. The key highlights for this segment is that although it's declining in terms of P&D, which is the portable navigation device, they have been offsetting that by increasing their market shares in the in-car installed systems, the OEMs. And we see that this is still a very profitable segment, which the management can actually milk it for cash and potentially also reduce the percentage R&D expenses. There's a potential to slash it and return some of the savings to the company and to shareholders. Okay, the second segment I'm going to share with you is the outdoor and fitness. This is the highlights of the, in terms of performance, it is a very high margin and high growth segments. In fact, this is the star segments of the few segments I'm going to highlight to you. In this segment, they have feature products like GPS locator, and especially the fourth runner 910 XT. Okay, this is a sports device that used to track detailed metrics for running, swimming, and cycling, etc. And if you have, if you are sports enthusiast, you probably have read some survey that this Garmin watch device is ranked well ahead of the big competitors such as Nike. Okay. R&D at this segment has been much lower at about a single digit 5-6% of the revenue, and the operating margin is very attractive at 38%. They have been spending R&D and marketing expenses for these segments to market the products. Okay, in terms of the revenue growth, this segment has compounded mid-teens earnings CAGR of about 16% over the past 4 years. Okay, another segment Garmin has positioned in is aviation. Okay, we are featuring here the integrated flight deck systems, or we call IFD. This segment has been gaining momentum in the past 1 year, and they've announced new partnerships with 9 aircraft models as compared to only 3 in the previous year. Okay, the operating margins in these segments is also very respectable at 25% operating margins. Okay, it is also recently featured in a Bloomberg video that shows that this IFD presence inside a jet suite, which is a popular private jet that is popular with the Silicon Valley executives. One thing about this segment is that it is a high barrier in the industry segment because of high R&D and the FAA certifications. Okay. Garmin also has a presence in marine. In fact, they have the widest range of products in marine. Products including like marine chart plotter, fish finder. Basically, these are the navigation systems. However, the marine industry has been slow to recover, and the outlook for the marine segments is also uncertain. But management is also using this period of time to invest heavily in the R&D for future growth. Okay. Now we are bringing you through the headwinds and risks in terms of segments. Firstly, to start with the automobile segments. As we mentioned earlier, the PNDs is continuing its secular decline. However, Garmin's automobile segments is picking up market shares in the auto OEM. In fact, he has outdone these key competitors like TomTom and Mio. Okay, in terms of the aviation and marine, these two we are putting it together as a segment review because these two segments compete primarily on functions, and Garmin is putting a lot of R&D efforts into these two segments for future growth, and they are competing with a lot of big players, which could actually outspend their R&D. But as of now, we can see that the aviation they managed to pick up momentum by increasing partnerships and we're expecting them to continue that momentum. Okay, as mentioned earlier on the outdoor and fitness, Garmin capitalizes on its GPS technology to capture this market. And their feature product that we showed earlier, the Garmin Forerunner, is actually ranked well ahead of Nike in market surveys. However, we see credible threats potentially from Apple and Samsung as they may be launching other similar products in this outdoor and fitness segments. Okay, Garmin is in this technology space, and as we know, the known unknowns is that the landscape is always changing rapidly, and we can't be sure that Garmin today will be the same Garmin 5 years later. But essentially, our call and our bet on Garmin currently is because the management has demonstrated prudence and competence to navigate the business segments and to offset the declining sunset segments by growing and high potential other business segments. And they did this by pursuing organic growth and also maintaining a very healthy balance sheet with zero debt, while at the same time also rewarding investors who stay with them via increasing dividend payments. And so they have in 2012 reincorporated in low tax Switzerland to take advantage of the tax benefits there. From previously they were in Cayman. Okay. However, this management competencies that we have seen so far, we have no guarantee that they will be able to continue to do so if there are changes in the management team. And currently, they have been building up cash piles as they have grown largely organically. In the future, the unknowns could be they may venture into depleting cash piles to pursue non-accretive or expensive M&A opportunities. In terms of earnings updates, the last earnings was in Q1. Okay, as I mentioned earlier, the declined revenue in the automobile and also in marine was offset by the increase in the aviation and the stable revenue from outdoor and fitness, giving us a very stable operating margins of about 20%. We look forward to the FY13 guidance to be updated after the Q2 results. In the balance sheet, the cash equivalent decreased slightly due to dividend payout and a tax-related prepayment. The company's strength in terms of the balance sheet and cash flow, it has approximately about $2.9 billion in cash and equivalents. In terms of excess cash in terms of excess cash of working capital is about 2.5 with zero short-term and long-term debt on the balance sheet. It is also clean because the R&D are fully expensed through the P&L and not built onto the balance sheet. And in the past, you can see from numbers here, they only spent less than 100 million on acquisitions versus net income generated of about 1.6 billion. Okay, free cash flow has consistently been higher, as also mentioned earlier, since 2009. And if we take out the excess cash from the market cap, the free cash flow at X the net cash will be giving us a very attractive yield of 11%. The attractiveness of Garmin stand as a standalone. First is you can see from the increasing dividend that shareholders are receiving from this company since 2009, almost doubled. In fact, despite it has doubled, it is still translating to about 5% yield today at today's price. It also incorporated in Switzerland, as mentioned earlier, because about 80% of this pre-tax income is attributable to non-US operations. There's also we also feel there's a strong alignment between management interests and shareholders, as the directors and associate holds 40% of the shareholdings. And meanwhile, the very lucrative outdoor and fitness segments is offsetting the declines by the automobile, while the management spending R&D in the aviation and marines to develop it for longer growth. In terms of catalysts, we view that the first catalyst we could see is that the company may down the road do a spin-off of a faster growing outdoor and fitness segments, or they could use the cash flow to repurchase the company shares. And thirdly, the Q2 and Q3 results may serve to allay investors' concerns that the Q4 results in last year is representative of a declining income expectations down the road. Okay. Operationally, we also mentioned in our earlier slides, there's a potential to have R&D spending, and we also believe Garmin will continue to gain market shares in the automobile OEM segments. In the past 1 year, we have seen more partnerships announced for IFD installations in the aviation segments. And if the marine recovers from a depressed market condition, we see it as a very positive signs. And outdoor and fitness in the past 1-2 quarters have been a bit stable and flat in terms of revenue. And if they resume strong growth, there will be a catalyst in terms of operationally. Okay, this is our sum of the parts versus the market cap at last Friday's price. As we have seen earlier, the outdoor fitness is a high margin, high growth segments, and we believe it deserves high multiples at 15 for its future growth. Aviation is also picking up momentum. Marine and auto are pegged at a much lower multiple. Okay, and added to the cash equivalents that they have, the sum of the parts realizable value we believe is approximately 8.9 billion versus a market cap of 7.2 billion. This translates to a target price of approximately $45 versus the last close price at about $37, giving us a approximately 23% upside, and we rate this trading buy. Okay, in conclusion, the main selling point for our official company today is we believe the market has been pricing in the secular declines in the automobile P&D segments, but not giving credit to the fast-growing and high potential segments in the outdoor and fitness and aviation and marine. At the same time, Garmin has a very healthy balance sheet and financial discipline, and you can see that the excess cash is more than 1/3 of today's market cap, and its growth is organic with little capitalized R&D, and investors who stick with it are still enjoying a respectable close to 5% dividend yield. And moreover, there are rooms to grow as the payout ratio is still well below 100% of the net income or the free cash flow. Okay, so we invite you, that's the end for our featured company presentation. We invite you to pose us the questions. Thank you. Okay, can hear. Hi, thanks for the question on Garmin. Now I'm going to address this questions from Devon. Who are Garmin's nearest competitors, which are not covered in the segments that we discussed? Okay, in terms of the automobile segments, the closest competitors would be TomTom and Mio. Mio is a Taiwanese manufacturer, and TomTom is large presence is in Europe. Okay, in terms of the market share that we've gathered, Garmin has a market share of approximately 60%, TomTom about 30%, and Mio is a distant 10%. Okay, in terms of aviation segments, the main competitors, the key competitors are actually Honeywell and United Tech. And in terms of the outdoor and fitness, because these are very different, they are broken down into even smaller sub-segments, so they are competing with different brand names. But a few key brand names that we've highlighted are Nike, potentially Samsung and Apple if they come up with the new product range to compete in these segments with Garmin. Hi, I have another question on Garmin. The question is, am I correct to say that their technology in GPS is a kind of commodities at this moment? Okay, it is right to say that the GPS is not a proprietary technology for Garmin, but what they're competing on is their heritage in this technology, and they are building up products for the different segment, especially in the outdoor and fitness based on this technology. Now, a bit of background on Garmin. It is actually set up in 1989, so he has been a strong global player with a strong presence for over 20 years. And for the aviation, they are competing based on a very high R&D expenditure of about close to 40%, and they also build up a very high entry barrier beside the R&D by having their FAA certifications and strong partnerships with the few aircraft manufacturers that we mentioned earlier, namely Piper, Cessna, Bombardier, Astrom, etc.
All right. Thanks for the questions on the economy. We'd like to address the first question on whether is there a squeeze in the U.S. debt market, which is pushing investors to equity markets. Right. On this front, especially for the U.S., what we are seeing is that equity markets have outperformed the fixed income market, and that is generally true for the global front as well. So global equity indices have actually outperformed fixed income. So, but having said that, we have not actually seen the great rotation out from fixed income into equities. in part because while theories have actually receded, they are still persistent, right? We still have the debt ceiling debate and many more lingering risk on the Eurozone front. So that brings us to the second question on whether we think that the fixed income bubble is actually going to burst. Now, if you look back what happened in 1994 when the Fed rates were actually hiked rather steeply. So the question is and that resulted in the bond bubble actually bursting, so-called to speak. So the question is whether will we actually see a repeat of such a scenario. Our view is that it's unlikely to happen because how things have changed since 1994 is that essentially right now the Fed has been rather forefront in communicating their expectations, in communicating their views on the economy and when will they actually scale back from these large-scale asset purchases. So any rate hike would actually be a gradual one rather than a steep one that you saw in 1994. So it's unlikely that the 1994 scenario of a bond bubble bursting would actually repeat. Yep. Okay, another question on equity risk premium. Now, equity risk premium essentially means the premium you get over a risk-free asset. So with a high equity risk premium, it could imply that there's actually value in the markets, and though it historically tends to have a negative correlation with equity prices, but at this juncture, high equity risk premium would actually essentially mean that there's value in equity markets. And the next question of whether does it mean that equity investors are more risk averse now? I wouldn't say so. I wouldn't think that they're more risk averse, but they're definitely having their own considerations as we still continue to see inflows into the fixed income space. And what that means is that there's not really a clear sign of whether the great rotation from fixed income to equities have actually materialized. So in essence, people are still having considerations on the downside risk on the forefront of the economy.
Hi, thanks. We have some more questions on Garmin. Firstly, please advise the PE growth rates and its RE and ROA. Okay, based on the last FY12 earnings, currently Garmin's PE is approximately 13 times 13. Is ROE and ROA. ROE is approximately 16%, ROA approximately 12%. In terms of the growth rate, because they have different segments and different profiles, we don't really have a blended growth rate that makes sense in describing the company growth. But as we've highlighted earlier in the Q1 results and in the different profiles of the segment description, the automobile is in the decline overall, and in the last quarter, the revenue decreased 10% year-on-year, but it was well anticipated. The outdoor and fitness was pretty stable over the last 2 quarters, while the aviation segment picked up momentum and it increased 10% year-on-year in the last result earnings. And other questions on Garmin. Why don't Garmin give out more dividends and hot cash like Apple? We don't think that is exactly the case because over the years, Garmin has been more than doubling its dividend payout from 2009 to last year. But yes, the management has been conservative as they build a cash piles, perhaps to look out for good opportunities to deploy into the business or to have acquisitions. At the same time, if they view that there's no attractive acquisition, we do see there's a potential of special dividends from this cash pile. Okay. Okay. If there's no further questions, that'll be the end of today's session. Thank you for your participation. I hope to see you next in our weekly market call next week. Thank you.